Look, I need you to be honest with yourself for a second. When was the last time you actually took a financial risk? And I'm not talking about buying a lottery ticket or throwing money at some cryptocurrency your cousin told you about. I'm talking about a calculated, intentional decision that made you genuinely uncomfortable but had the potential to change your financial trajectory. Here's the thing, most people think they're being smart with money by playing it safe. They keep everything in savings accounts, earning 0.5% interest while inflation eats away 314% of their purchasing power every year. They stay in jobs they hate because the paycheck is reliable. They never start that business because what if it fails? And then they wonder why, 20 years later, they're in the exact same financial position they were in their 20s, just older and more tired. But here's what nobody tells you. There are actually 5 distinct levels of financial risk, and the people who understand how to climb through these levels, strategically, not recklessly, are the ones who end up building real wealth. And I'm not talking about trust fund kids or people who got lucky. I'm talking about regular people who just understood something about risk that you probably don't. My name is Dan, and I spend way too much time thinking about why some people build wealth while others stay stuck in the same financial position their entire lives. If you're someone who's been doing all the right things with money but still feel like you're not making the progress you should be, make sure to hit that subscribe button and give this video a thumbs up if this helps you out. So here's what most people don't realize about wealth building. The biggest risk you can take isn't losing money. It's never giving yourself the opportunity to make significantly more. Let me put this in perspective. According to research from Fidelity's Millionaire study, the average self-made millionaire in America failed at an average of 3.8 businesses before they succeeded. 3.8. That means they took financial risks, failed, learned, and tried again, multiple times. Meanwhile, the average person takes maybe 1 or 2 significant financial risks in their entire life, if that. And look, I get it. Risk is scary. We're biologically wired to avoid it. There's this concept in behavioral economics called loss aversion, where studies show that the psychological pain of losing $100 is about twice as strong as the pleasure of gaining $100. Your brain is literally designed to overweight the downside of risk and underweight the upside, which is great if you're a caveman trying not to get eaten by a tiger, but it's terrible if you're trying to build wealth in modern society. The first level is where most people live their entire financial lives, and I call it the safety trap. This is where you're working a W-2 job, maybe contributing to a 401k if your employer matches, keeping most of your money in a savings account or checking account, and basically hoping that doing everything right will somehow lead to wealth. Here's the problem. This level isn't actually safe. It just feels safe. Let's do the math. The average American has about $8,000 in savings, according to a Northwestern Mutual study. If you keep that in a high-yield savings account today, earning let's say 4% interest, which is actually pretty good right now, you're making $320 a year before taxes. After taxes, you're looking at maybe $240. That's $20 a month. Meanwhile, if you're spending that money on things that depreciate, like a new car payment at $500 a month with a 7% interest rate, you're losing thousands of dollars a year just to interest and depreciation. But here's what's even crazier. Staying in this level means you're trading time for money in a linear way. If you make $25 an hour and work 40 hours a week, you make $1,000 a week. Work 50 weeks a year, that's $50,000. To double your income, you'd need to double your hours, which you literally cannot do. You've capped your upside. Now you might be thinking, but Dan, I need stability. I have bills to pay. I hear you. And I'm not saying quit your job tomorrow and wing it. But what I am saying is that if you stay at this level forever, you're essentially guaranteeing that you'll never build significant wealth. You're playing not to lose instead of playing to win. Level 2 is what I call the educated gamble. This is where you start putting money into assets that have historically created wealth. Index funds, real estate, maybe starting a small side business while keeping your day job. Here's where it gets really interesting. Let's say you take $10,000, which I know is a lot for many people, but stay with me. And instead of keeping it in savings earning 4%, you invest it in an S&P 500 index fund. Historically, the stock market returns about 10% annually on average over long periods. Some years it's down 20%, some years it's up 30%, but the long-term average is around 10%. That same $10,000, invested at 10% annual returns and left alone for 30 years, becomes $174,494. In a savings account at 4%, it becomes $32,434. That's a difference of over $140,000. Same money, same time period, completely different level of risk, completely different outcome. But here's the psychological shift that has to happen to get to this level. You have to accept short-term volatility for long-term growth. You have to be okay watching your investment drop 15% in a bad year, knowing that historically it recovers and then some. Most people can't do this. They see their account drop from $10,000 to $8,500, and they panic sell, locking in their losses. There was a study by Dalbar that found that the average equity investor earned only 3.7% annually over a 20-year period, while the S&P 500 returned 9.9% during that same time. Why? Because people panic when things drop and sell at the worst possible time. They let emotion override strategy. The people who make it to level 2 and actually stay there understand that this volatility is the price you pay for higher returns. They've done their research, they understand the historical data, and they have the emotional discipline to stick with the plan. Level 3 is where things get uncomfortable for most people, and this is where wealth starts accelerating. This is what I call the concentrated bet, putting a significant amount of your money, time, or both into a single opportunity that has asymmetric upside. Here's what I mean by asymmetric. The potential gains vastly outweigh the potential losses. Starting a business is the classic example. You might invest $20,000 in 20 hours a week for 2 years building something. Worst case, you lose that $20,000 in those hours. Best case, you build something that generates $100,000, $500,000, or more per year in profit that you own. Look, according to IRS data, about 9% of American millionaires are entrepreneurs or business owners, despite business owners making up less than 15% of the workforce. That's not a coincidence. Business ownership provides leverage that a salary simply cannot. But here's the thing that nobody tells you about this level. It's not actually about the money you invest. It's about the opportunity cost. If you're spending 20 hours a week building a business, that's 20 hours you're not spending watching Netflix or scrolling through social media or doing overtime at a job that pays you linearly. That's the real risk. You're betting your time and energy on yourself instead of on guaranteed comfort. I'll give you a concrete example. Let's say you're making $60,000 a year at your day job and you start a side business. You invest $15,000 of savings and 15 hours a week for a year. That $15,000 is your capital risk. Those 15 hours is roughly 750 hours over a year. At your current salary rate, that's worth about $21,600 in opportunity cost. So your total risk is really about $36,600. Now let's say the business fails completely. You lose that $6,600 in value. It hurts, but you still have your job and you learned a tremendous amount about business, sales, marketing, and yourself. But let's say it works, even modestly. After a year, the business is generating $2,000 a month in profit, $24,000 a year. That's a 40% annual return on your initial investment, and it's now an asset that could grow. Keep building it, and in 5 years, maybe it's generating $100,000 a year in profit. Maybe you sell it for 3x annual profit, $300,000. That's the asymmetry. The downside was capped at around $36,600. The upside, potentially unlimited. And even if it fails, you gained skills and knowledge that make your next attempt more likely to succeed. Level 4 is where most people never get because it requires something that's even scarier than losing money. It requires changing who you are. I call this the identity shift. Here's what I mean. At this level, you're no longer just someone who has a side hustle or who invests. You're someone who sees themselves fundamentally differently. You quit the stable job to go all in on the business. You move to a different city for a better opportunity. You walk away from the golden handcuffs and the pension and the "what will people think?" This is where the risk becomes existential. Because if you fail at this level, you don't just lose money, you lose your identity. You become the person who quit their great job and failed. You become the cautionary tale your family tells at Thanksgiving. But here's what's fascinating. Research from the Kauffman Foundation found that the average age of successful entrepreneurs at the time they founded their successful company is 45 years old. Not 25, 45. And many of them had failed multiple times before their success. They had to shift their identity from "I'm an employee" to "I'm a business owner" to eventually "I'm a successful entrepreneur." Let me give you a real psychological framework for understanding this. There's a concept called the psychological immune system that researcher Dan Gilbert talks about. Basically, humans are remarkably good at adapting to new circumstances, even negative ones. We think that if we lose our job or our business fails, we'll be devastated forever. But studies show that most people return to their baseline happiness level within months, not years. What this means practically, the fear of the identity shift is usually way worse than the actual experience of the shift itself. Your brain is catastrophizing the downside while ignoring your own resilience. People at level 4 have usually gone through enough failure at levels 2 and 3 that they've realized something profound. Their worth isn't tied to their job title or their bank account or what their parents think. They've decoupled their self-esteem from external validation. And paradoxically, that's exactly what allows them to take bigger risks, because the downside isn't really that scary anymore. And then there's level 5, which is what I call the legacy move. This is where you're risking everything you've already built to build something even bigger, not primarily for yourself, but for impact, for legacy, for changing something fundamental. At this level, you might be investing millions into a new venture. You might be buying a struggling company and trying to turn it around. You might be launching something that could either make you generationally wealthy or bankrupt. The financial risk is enormous, but you've usually already achieved enough financial security that the risk is really about something else. Significance, contribution, the game itself. Look, this isn't relevant to most people watching this video right now, and that's fine. But it's important to understand that this level exists because it shows you something crucial. As you move up these risk levels, the nature of risk itself changes. At level 1, risk is about survival and safety. At level 5, risk is about meaning and legacy. According to Forbes, about 88% of millionaires are self-made, meaning they came from middle class or lower backgrounds. And if you study their paths, you see this pattern. They systematically moved through these risk levels, getting comfortable with bigger and bigger bets, until eventually they made the one big bet that changed everything. Now you might be thinking, okay Dan, this is all great in theory, but what am I supposed to actually do with this information? Here's the framework. First, figure out what level you're currently at. Be honest with yourself. If you're keeping all your money in checking and savings and never investing, you're at level 1. If you're investing but only in super safe things and you panic when the market drops, you're maybe at level 2 but not really committed to it. If you've started a business or made a significant investment in yourself, you're at level 3. And so on. Second, identify what's keeping you from moving to the next level. Is it lack of knowledge, fear, comfort, social pressure? You need to name the obstacle specifically because you can't overcome what you won't acknowledge. Third, start building the skills and mindset for the next level while you're still at your current level. If you're at level 1, start educating yourself about investing. Read books, take courses, open a brokerage account and invest $100 just to see how it feels. If you're at level 2, start thinking about what business you could start or what concentrated bet you could make. Test ideas. Talk to people who've done it. Fourth, and this is crucial, understand that moving through these levels isn't about being reckless. It's about being strategic. Every level should have a risk management strategy. At level 2, that might be diversifying your investments and only investing money you won't need for at least 5 years. At level 3, that might be keeping your day job while building your business until it replaces your income. At level 4, that might be having 6 months of expenses saved before you make the leap. The people who build wealth aren't the ones who take stupid risks. They're the ones who take calculated risks that most people are too afraid to take. Here's the thing that nobody wants to hear. If you're not uncomfortable with your current level of financial risk, you're probably not growing. Comfort is the enemy of wealth building. I'm not saying you should gamble your rent money or quit your job with no plan. But I am saying that if you want significantly different results than you're currently getting, you need to be willing to do significantly different things than you're currently doing. And significantly different things feel risky because they are risky. There's this quote I think about a lot from billionaire investor Ray Dalio. He who lives by the crystal ball will eat shattered glass. Meaning, you can't predict the future. You can't eliminate risk. You can't guarantee success. But what you can do is put yourself in positions where the potential upside is worth the potential downside, where you're playing a game you can win over time if you keep playing it intelligently. Look, here's what I want you to take away from this. The path to building wealth isn't about being lucky or being smarter than everyone else or having some secret knowledge. It's about understanding these 5 levels of risk and systematically training yourself to move through them. It's about getting comfortable being uncomfortable. It's about recognizing that the biggest risk isn't losing money, it's spending your entire life playing it safe and never giving yourself the chance to win big. Most people will watch this video and do nothing. They'll think, that's interesting, and then go back to doing exactly what they were doing before. But some of you, maybe 5%, maybe 10%, will actually sit down today and figure out what level you're at and what you need to do to move to the next level. You'll make a plan, you'll take action, and a year from now, 5 years from now, 10 years from now, you'll be in a completely different financial position because you are willing to do what most people aren't. So that's it. If this helped you understand risk differently, hit that subscribe button and give this video a thumbs up. Drop a comment below and let me know what level you think you're currently at and what's holding you back from moving to the next one. I read every single comment and I'll respond to as many as I can. Thanks for watching. Now go take some calculated risks. Claude can make mistakes. Please double check responses.